All right, so the next one we're going to walk through is 212B from your B set problems. This one should be a little quicker than 28B, a little less involved. However, still an incredibly important concept that we're talking about here. We're talking about the allocation of some cost, right? So we're talking about what happens if you forget to make an adjustment. It's incredibly important to make adjustments. We talked about this a little bit in class where we have to make these adjustments. We have to make these closing entries just to make sure that our account balances are correct, because if they're not correct and we send them out and people are making decisions on them, they're making poor decisions on poor information, and we do not want that to happen. So we have to make these adjustments to make sure that our account is correct. This particular problem, it's going to walk you through the adjustment, and it's also going to talk about, hey, what happens if you don't make that adjustment? What happens to your balance sheet? What happens to your income statement? And you can see kind of the what really could be a catastrophic impact if you are not careful and make your adjustments appropriately. So here it tells us that on June 1st of year 3, Cole Corporation paid $8,400 to purchase a 24-month insurance policy. We're going to assume that Cole records the purchase as an asset, and the books are closed on December 31st. So these are a couple of really important things to note here. The first one is it's June 1st of year 1. Okay, that's a really important thing to note. The second important thing to note is that they closed the books on December 31st. So we're going to be making that adjustment on December 31st. What that tells me is that I will have had it for June, July, August, September, October, November, and December. So I've had it for 7 of the 24 months. What we'll use here is a formula, which is going to be the amount times n over the period. So for us, the period is going to be 24 months. The n will be 7. So essentially what we'll do here is we'll take that $8,400. Okay, we're going to multiply it times 7 over 24. Okay, that's going to give us this essentially, right? 8,400 times 7. That's $58,800 over 24, which equals $2,450. Okay. What this amount represents is our insurance expense each month and our adjustment each month. So every month we have to make this adjustment and make this expense. The adjustment is going to be made to the prepaid insurance asset. The expense will be charged to insurance expense. So we'll see exactly what we're talking about when we pull this back up here. So when we purchased the insurance, what did we do? Well, we had a loss of cash, right? So we reused cash to get a new asset called prepaid insurance. Had no impact on common stock, okay, and no impact on retained earnings because there is no expense yet. So there is no impact on retained earnings. So let's say, however, right, that now it is December 31st and I have to make an adjustment. So I told you guys wrong here. This isn't each month. This would be for the first 7 months. Each month you would put a 1 here. So 8,400 times 8,400 divided by 24 would be $350. And then you could take 350 and multiply that times the 7 to get the 2,450 that we're going for our full 7 months that we've had the insurance policy, for the full 7 months that we've used this insurance policy. So we're going to plug that number in under the prepaid insurance. We are going to reduce prepaid insurance by $2,450 because we've used up that much of the prepaid insurance. Again, there is no impact on common stock, and the impact on retained earnings, since it is an expense, is negative $2,450. Okay, so again, no impact on cash either there. So the totals in cash, our total outflow of cash was $8,400 for operating, right? our total prepaid insurance left, that's what's left in the account. So essentially look at it like this, right? Let me get this cleared off real quick. So we're going to look at it as though we've got it in a T account, just to show you what's happening. So we've got prepaid insurance as our T account. It is an asset, okay? So we're going to increase on the left here. So when we started, we had 8,400. And then after 7 months, we had used 2,450, which left us with a balance of 5,950, okay? So that's how that's working, an addition here, a subtraction here, and a balance at the bottom, okay? So we'll go ahead and enter that amount there. Again, no impact on common stock at all. And then our retained earnings reduced by $2,450. That was the reduction in retained earnings. So this is the impact that we had. Now, if we did not make this entry, assets and stockholders' equity, right, would each be overstated. Okay, by $2,450, right? Because we would have said we still had those assets left and we still had those retained earnings left. Okay, that's on the balance sheet. On the income statement, right, our expenses, right, would be understated, which would cause our net income to be overstated, right? If we reduce expenses, we increase net income, and it would be overstated by $2,450. So that is the kind of thing that can happen if you're not careful and if you don't make appropriate adjustments to your accounts. If you're not making these adjustments to your accounts, what you'll find is your balance sheet will probably not balance, but if it does, there's an error in it. So again, any questions or anything, just let me know, send me an email.